Ladies and gentlemen, good day and welcome to Galaxy Surfactants Ltd Q1 FY25 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. K. Natarajan, Managing Director from Galaxy Surfactants Ltd. Thank you and over to you, sir.
Thank you. Very good morning, ladies and gentlemen. On this call with me is Mr. Vaidyanathan Kulkarni, my Chief Operating Officer and Executive Director, and Mr. Abhijit Damle, our Group Chief Financial Officer. So once again, very good morning. It gives me immense pleasure to welcome you all to our first investor conference call for FY2024-25. As I look back at the quarter gone by, the comparative that comes to my mind is that of the hare and the tortoise story, a story we have all grown up hearing but perfectly descriptive of the scenario today. At one end, we have the volatile supply chain and geopolitical escalations which, like the hare space, have been changing rapidly. And at the other end, we have the demand scenario which, like the tortoise, has been slowly but steadily improving across geographies. In a world destabilized by volatile macros, logistical challenges, and elongated lead times, attaining the upper range of the guided volume growth was a major positive in this quarter. I strongly believe the volume momentum should sustain going ahead, driven by growth across all geographies. While volume growth was in line with our expectations, the EBITDA per metric ton came in at rupees 20,197 per metric ton, slightly below the guided band of rupees 20,500 to 21,500 per metric ton. Higher supply chain costs across all locations contributed towards this being lower than the guided range of 20,500 per metric ton. Despite multiple challenges, I believe we are on track to regain our profitability trajectory. There are visible signs of improving demand for our premium specialties, which should enable an improvement in our overall profitability. Volume growth across all regions and segments was a major positive in this quarter. James Clear, in his book Atomic Habits, has said, "We often dismiss small changes because they don't seem to matter very much in the moment." Drawing inspiration from the same, I now will take you through the small but important improvements that have happened in this quarter, as these will play an important role as far as this year's performance will be concerned. Starting with India, which grew by 2% in this quarter. While this may appear to be relatively slower compared to the double-digit growth we have seen in the last 4 years, this comes on the back of a relatively slower April that we had, but an extremely strong May and June. Above average monsoons, revival of rural spending, along with a consumption incentivizing budget, should ensure strong momentum going ahead. Despite the geopolitical escalation and Red Sea crisis, Africa, Middle East and Turkey grew by 4.9% in this quarter. This is a major positive. Small but steady improvements seen quarter on quarter, despite deteriorating macros, gives us the confidence that the path to revival which began in H2 of FY2023-24 is now moving towards the path of growth. We remain cautiously optimistic and are working towards delivering on a high single-digit growth this year in our Africa, Middle East and Turkey markets. As the rate cut cycle gathers momentum, improving household spending has slowly translated into strong demand for masstige categories. This is a phenomenon visible across all developed markets. This quarter saw your company growing by 24.5% in rest of the world markets, driven by strong growth seen in Europe and Latin America. We strongly believe the momentum in masstige categories should translate to strong double-digit growth for these markets. Improving consumer sentiment should accelerate new launches of premium specialty products, which in turn should aid our premium specialties from H2 FY24-25. As one can see, your company has grown across all regions in this quarter, Even segmentally, while our performance surfactants grew at 5.4%, specialties driven by Mastic recorded 13.3% growth. While overall volume growth stood at 8%, sequentially as well as year-on-year, we saw growth in our EBITDA. While demand remains steady across geographies, capitalizing on the same, given the supply-led volatility was the major challenge. Unavailability of containers, port congestion at some of the major ports in the world, combined with higher lead times and rationalized availability of raw materials, did adversely impact the volumes in this quarter. A more supportive environment would have resulted in strong double-digit volumes growth for a company. To conclude, as Greek philosopher Epictetus had said, just keep in mind that more we value things outside of our control, the less control we have. In line with that, at Galaxy, we remain focused on what we can control, be it in terms of new launches, leveraging and enhancing our share with customers, adding new customers, or building capabilities, competencies, and competitiveness across businesses. Our endeavor remains to focus on improving ourselves as an organization. As instability, volatility, and crisis gather steam, we at Galaxy remain fully committed and focused towards ensuring stable, consistent, and improving performances. Thank you, ladies and gentlemen.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, wait for a moment while the question queue assembles. The first question is from the line of Aditya Ketan from SMIFS Institutional Equities. Please go ahead.
Thank you, sir, for the opportunity. First question is on to the improvement in your per kilo EBITDA spreads for this quarter. Sir, despite these logistic challenges and the continued Red Sea crisis, you had also mentioned in your presentation that raw material arrivals were impacted and dispatch of finished goods, and higher freight rates also could have been there. But despite this, our other expenses has gone down on sequential basis. Any particular reason, sir, for the same?
No, see, the other expenses typically it is more in terms of freight, because freight is part of the revenue in terms of based on the Incoterms that we have. So typically, there are some, if the DDP shipments were lower during this quarter, then, the revenue, the DDP costs are much higher than CAF freight costs. So that can be the only explanation for that, nothing else.
Okay. And sir, there was availability of containers, like have you faced this problem, or like, so we were having very smooth operations for this quarter into the exports market?
No. It wasn't smooth at all. That's what I said during my opening address, that the challenges actually aggravated pretty significantly from May onwards. It was both incoming and outgoing. So there have been, your transit times have got elongated, congestions across all the major ports, and even availability of containers and slots. Forget about the rate increases, even availability has become a challenge. But yes, my team has been doing a fantastic job in terms of managing in this new normal, and we do hope that if the situation doesn't escalate, my team has found a way to manage despite all these constraints.
Okay, so this has started from May, as you mentioned. So, like for the coming quarter, can we see some softening of volumes, or it will be again smooth only?
So see, what I'm saying is that the demand scenario looks robust across geographies. The supply chain situation, though not improving, at least should not deteriorate. If it doesn't deteriorate from where it is today, we don't see any reason why we can't have a good volume growth next quarter as well.
Okay. Sir, onto the volume performance, as mentioned in your presentation, that the rest of the world markets has seen a good improvement. Any particular geography which we can mention, like which has seen sharp uptick in demand or in volume?
Yeah, so we have Europe, we have Latin America, we also have Asia Pacific.
Okay. Okay. And sir, this will continue going ahead, and along with this, you expect the AMET market also to like perform, or it will remain flattish like in terms of volume growth from here?
No, see, because the rest of the world is growing by 24.5%. Also, we need to understand is based on a lower base that was there in the corresponding quarter last year, because the destocking impact started happening only from that quarter. So that is one. So, but yes, given that, we still have a good robust demand emerging from these geographies, and we will continue the growth momentum. With regard to the Africa, Middle East, Turkey market, again, we see no reason why our demand growth that we had this quarter cannot be continued. The only spoiler can be if the supply chain situation worsens beyond what it is today.
Okay. Okay. So this quarter onto EBITDA per kilo, like there is a very good improvement, standing at around 19.5 rupees per kilo. So sir, like we had guided for 20.5 to 21.5 as the guidance. So are we on track to beat that guidance also, considering this Q1 numbers, and if there is significant improvement from here on?
So what we had said when we guided to the higher end, when we increased the range of guidance to from 20,500 to 21,500 band, we had said very clearly what is going to make us hit this higher band is we expect the premium specialty ingredients to start catching up from the H2 of this year. So we continue to remain consistent on that, and we do hope that once that happens, we should see the EBITDA per metric ton also tending towards the higher end of the band.
Got it. Got it. Yeah, thank you.
Thank you.
The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, good afternoon, Natarajan. Thanks for taking my question. Good afternoon, sir. First, on the India market, it's because the other FMCG companies have also reported the slower volume growth. But how has been the trend post-June? Is it holding up the faster growth of May and June even in the July and beyond quarter?
Yeah, so far we are seeing that holding up.
They are holding up. Okay. Okay. And from next quarter onwards, this should at least again cross that mid-single digit kind of a volume growth, right?
It should, but as all our customers' commentary, if you see, they're seeing that the rural demand is coming up in last quarter, and they expect that to continue, given the good monsoon that we have had and the budget that has put more money in the hands of the rural consumers. So with all this in place and the price corrections that have happened, surely it is poised, rural demand is poised to register good growth. So we do hope that really transpires into a good demand for us as well.
Got it. Got it. On AMAT, somehow it feels that I thought we can grow by double digit because base was very favorable, and we are still at the mid-single digit of 5%. What is happening in AMAT? Is recovery slower or competition more aggressive? What's happening on the AMAT market?
No, AMAT actually we could have done much better. But
Okay.
then, as I said, they had severe issues in terms of getting incoming consignments. Because of the Red Sea issue, the incoming raw materials were severely impacted. In fact, we had containers coming almost 30-40 days after their scheduled date of arrival. This kind of uncertainty, production also got impacted. I think there was no dearth of demand to cater to. The issue was in terms of availability of feedstock to continue production, which is getting better now. Which is getting better in terms of the way we have started managing it. So if the situation doesn't deteriorate further, I think we should see some good numbers moving forward.
So for remaining 3 quarters, if assuming supply chain issue normalizes, we should be hitting a double-digit growth at least, right? In a math market.
Yeah, that is what we are aiming at. We do hope that the environment supports us. That's what is our endeavor.
Got it. You mentioned about premium product launches in the H2. Are you hinting at product taking it to more geographies, or are you hinting at new product launches itself?
No, I didn't say new launches. See, what had happened, Sanjesh, was over the about last 12-15 months, because of the cutback in demand that happened in US and Europe, the destocking and all that, led to many of our customers where we had started certain projects in pipeline for our new products. They had actually suspended work on that because they were finding that the demand itself has gone to quit. So that has recommenced in terms of the work on that.
So you are telling that the premium product which customer were launching, which were not launched because of the weaker market, are getting launched now.
Correct. So we have got some indications from customers that they have revived those. If that is the case, it also means it has translated into they taking those premium specialty ingredients from us, which will then help us in terms of a better EBITDA per metric ton in H2. That's what we say.
Natarajan, can you give a little bit more color on the specialty? What is driving more growth for us? It is preservatives, it is mild surfactant, or it is value-added products. What actually is driving growth in the specialty for us?
Actually, it's a combination. It's not that one of it. So we have preservatives, we have mild surfactants, we have our non-toxic preservatives. Okay, and also some of the new products that we launched, we are seeing some early victories. That also has started. So that's why it's a well-rounded and a well-spread out this thing in terms of specialties. But we would want the premium specialties to now contribute more, and that obviously depends on our customers resurrecting the launches that they had held back.
When you say premium product, what are these products are we referring to?
No, you're talking about, say, high-end cleansing solutions. You're looking at high-end cleansing bars. You're looking at, say, solid format shampoo bars. You're looking at high-end skin moisturizing creams, which require better emollients and high-end emollients. You're looking at certain formulations that require safe preservatives, natural ingredients, or ingredients with more naturality index. I'm talking about these sort of.
Okay. And how has been proteins doing for us? I think we expanded the capacity in Tricare as well. How has been the performance of proteins for us?
So it has been good. So this quarter was a revival quarter as far as that business was concerned, because that suffered significantly last year in terms of the destocking that happened in US and the way Europe demand was very tepid. That has started getting revived. So I think that's good. So that also was one of the highlights of first quarter in North America business.
Got it. Thanks, Natarajan, for patiently answering all those questions, and best of luck for the coming quarters.
Thank you, Sanjesh. Have a good day.
Thank you, sir. Good day.
Thank you. The next question is from the line of Arun Prasad from Avendus Spark. Please go ahead.
Yeah, thanks for the opportunity. Good morning, Natarajan ji.
Morning.
My first question is once again on the specialty care growth of mid-20. So how much of this growth we can attribute to, say, restocking, and how much is to be, say, because of the customers' new product launch? Because last time we had this container issues, customers were over-ordering more than they required. So there will be a little bit portion of the growth attributable to that as well?
Unfortunately, I don't have the split that you're asking for, but the right question. But then I'll hazard a guess here. Probably, I think about 40% of this can be attributed to the stocking of happening, restocking, as I can call it. The balance is in terms of, certain geographies where we also got some newer businesses. So I could put it that way.
Right, sir. So that means maybe this very high double-digit growth can also be attributable to the low base, which should slightly normalize from the second half. That's the way to think about this.
Yeah, but that is the way to think. If what is currently happening will continue, but then if we have certain products that are in the pipeline, which the customers are now looking at reevaluating and relaunching, with their suspended last year, it can be a different story. But if it is without that, it just continues, that to me, because, and it also means that if the demand really picks up, companies will also start restocking, because many of the inventories at my customers end and also at the end, at the retailer end is also been reduced significantly. And the people are now, with the demand being robust, they would start looking at restocking and increasing inventory levels to the normal thing it should be. Right now, many of the inventory levels are pretty tight across the value chain. Okay, and so I think that also can be a this thing, that restocking also should happen. Okay, which can also be one other positive in terms of the demand.
Right, sir. So last time we spoke, you indicated the specialty volumes, if it reaches around 105, then you will kickstart the capex program. Now, looking at the current growth trajectory, we should be very close to that level. So the capex on the specialty side, is it in the annual?
Yes, so there is one which is already under implementation execution. I think we're looking at it getting commissioned by end of this financial year. Okay, and there is something more that is on the drawing board, which we are working on. Yes, because we always need to be having capacities ahead of the demand coming in. So that we are well preparing, because we can't afford to lose any demand because we don't have the capacity. So that we are very much on track.
Just a bit more color on this capacity, sir. It will be more on the non-toxic preservative or mild surfactants, where we see very high incremental growth as compared to the capacities currently we have.
No, it will actually be in. It can't be said which one it will be, because many of the high-end formulations will require both mild surfactants and non-toxic preservatives and high-end emollients, okay, and emulsifiers. So this is something that will be across. So we may not be able to very clearly demarcate to say as to which will be the sort of capacity that will get set up. Because we have to be, some of them will be demodeling, some of them will be brownfield investments that we will be doing.
Understood. Sir, my second question is on India. Last 2 quarters, the growth has slowed down. But we have given a commentary that it hinges upon the rural demand recovery. So anything else which can help us deliver better apart from rural? Do you see any potential from the urban side also? Any indication from the customer that this can rebound back, even if the rural doesn't come out?
Yes, see, what has happened, Arun, is that all the FMCG companies have started taking price cuts, reduced prices only over the last, probably most of it happened in the last quarter, very significantly. So now that should start transferring demand, because good demand from both rural and urban. Okay, and all of them have started reporting. If you see, all my customers have started reporting after a long time a volume-led growth and not a value-led growth. In fact, value growth is negative. The entire growth is coming through volume, which essentially indicates, okay, that these price corrections they have done is yielding results in terms of volume growth, and we do expect that will start translating into volume growth for us also in line with that. In India, again, if you see, it's only because many of them, when they took price corrections, they also want to ensure that the inventory is kept at minimum, correct? Because they don't want to be having high price inventory and the new price lower price inventory existing together. So that also starts resulting in sudden cutback in terms of their production. And now once the demand is intact, you will have restocking happening. They build up the inventory pipeline again, and that will be good. So in India, if you see, the real barometer is the festive demand that starts from August, September, October. Demand will determine as to whether the demand growth has come back on track. So we'll wait for that. The current indications tell me that my customers are optimistic that it will sustain.
Thank you, sir. One clarification, you said the price cuts happening on the ground. Is it a direct price cut or is it via the grammage increase, sir?
No, there are multiple. There are combination of this. Price cut also has been cut. There are if you buy a pack of 2, 1 is free. Okay, you also have grammage increase. Okay, so it is a combination of all this. You have some customers doing this, some customers in some products, they end up doing grammage increase. Some products they're giving 1 for 2 free. In some, they are looking at taking clear price cuts. So it's a combination that is happening.
Okay. So this grammage cut which has happened recently, that is where your hope is, you're hopeful that India volume growth will bounce back.
Yeah, so
and along with the residual demand. Is that right understanding?
So can you repeat your question? I think I lost you in between.
So this grammage cut which was taken recently, that is where we are hopeful that the India volume growth can come back. Is that right understanding?
So typically the FMCG consumers will always look at grammage increase before they actually take a price cut. Because the grammage increase will tell them whether the demand is really come. That's the way to test out. Similarly, when they give 2 for 1 free, it tells them, because if you do a direct price cut, then you can't again take the price up. So these are the ways for them to test out. So that's what they're doing. Once they realize that it is complex, they will then get back to actual price cuts. So they will convert those grammage increase to a price reduction and restore the grammage that was there earlier. So that's typically what they do every time. Like they do the same thing when they do increase price. They don't increase the price in the first case. They reduce the grammage. Okay. Then they look for what is it, and then they slowly start increasing price. So the same thing they do it when they have to unwind this price increase cycle.
So in this cycle, where we are at this point of time, so we have already seen grammage cut and demand is picking. So I just wanted to understand, we are in which part of the cycle in this?
So right now, based on the commentary that my customers are giving, today morning I read something of AC Nielsen. It tells me that rural demand is really picking up, which is good, and all our customers are looking at getting into rural areas where even there are 1,000 consumers using AI and all that to tell their sales team as to how exactly to target consumers with what products there in rural area, which is good. But right now, if you see, all of them are telling very clearly that all that they're doing in terms of price reduction is resulting in green shoots in terms of demand looking up, and they expect this to continue. So we are also seeing that this is continuing. Only thing is we need to see it going up to much higher levels, which should happen in the festive season, as I just told you.
Thank you, sir. Thanks for your very insightful answers on this.
Thank
you. Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer questions from all participants, please limit your questions to 2 per participant. And if you have a follow-up question, please fall back in the question queue. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity and congrats on a good set of numbers. So first question is the absorption of the incremental logistic cost. So given that it's been almost 6 months since the Red Sea issue started happened, whether those costs have now been completely passed on to the customers, and whether the customers have completely absorbed this price increase, and here on, given the current environment remains the same, the pricing part from the logistic cost will not affect us. So just your thoughts on this one. Thank you.
Yeah. So I think we have been, obviously it gets passed on with a lag. So I think with the increase, if there are no further increases that happen, I think we would have been successful in passing on all the increase. But what happened last quarter was something also different, where the incoming freights went up significantly, and that results in raw material costs going up, which we are in the process of passing on. But I only hope, as I said earlier, that from October, the shipping companies tell us that things should start stabilizing. So till the time, we will have to find ways to ensure that we are able to engage with the customers and ensure that we are able to judiciously pass on the increases.
Sure, that's helpful. And my second question is in terms of our future growth from new product development. So are there any pockets which are currently untapped by us, maybe in specialty care products, and where we are currently working on, and these probably will be giving us incremental growth? Given that, historically also we've been always specifying that 6 to 8% volume growth is largely what we expect, given the FMCG grows slightly below that. So are there any such untapped areas which we are working on, and those will continue to give us volume growth to an extent? And obviously the margin improvement, what we have suggested, 4-5% every single year, that will also be on track.
Yeah, so untapped will be in terms of geographies that we need to be further penetrating, also in terms of certain things that we need to increase our basket of ingredients with customers, which also we are doing. With regard to new products, okay, we know that there are certain consumer trends which our innovation team is working on in terms of coming up with product solutions. So those will be something that we can say is untapped because we're still not ready with the product. But the good amount of products that we have launched, and we have initiated a lot of projects in pipeline with the customers, we should see it translating, okay, into demand as the quarters go by. So we are well positioned across all segments. So we need to be coming up with newer product ideas in line with the consumer trends and commercialize them. We also have to ensure that whatever we have launched, that we need to be ensuring that we are able to get better revenues and margins out of that, which is what we are working on, and which is what got stalled in terms of development by customers because of the unfavorable demand situation in the developed markets, which is getting revived now, which augurs well for us in terms of the way that S2 and onwards will look. And we also need to focus on how do we acquire more customers. We also penetrate geographies that we are currently under-penetrated. So it's a combination of all this.
Sure. Just one clarification on this. In terms of the innovation funnel, normally how much of that is driven from our side, and how much of that is coming from customer end in terms of certain applications or specific criteria?
So I think what we come up, so it probably can be, say, you can say 50-50, 60-40, 50-50 in terms of what we come up with and sometimes what customers tell us as what they want. So it's a combination. So some of the innovation pipeline also involves process innovation that we do, which is in line with the sustainability agenda. So that's also something is part of that. So you can say just to be back of the envelope calculation, I can tell you about 50%, 50 to 60% can be what is initiated by us, and the balance 40-50% can be what the customers then prod us into thinking.
Sure. Thanks for all the answers and all the best, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Krishan Parwani from JM Financial. Please go ahead.
Yeah, hi. Good afternoon, sir. Thank you for taking my questions. Just couple of clarifications. So, does this quarter, volume includes the 2,500 metric ton deferred volume from the last quarter?
Yes, it does. And some volume from this quarter also got deferred to next quarter in terms of whatever we could not service because of supply chain issues. This continues. So this includes both.
Okay. And secondly, did favorable inventory kind of help you in making higher per kg EBITDA?
No, not exactly. Not exactly. It was more in terms of my specialty ingredients contribution going up also helped. Okay. Plus also in terms of we managed our raw material positions well, because the raw material prices also were on a steady or an increasing side. So, but not very significant. Okay, but then it was more in terms of how do you manage the freight situation. That was important. In terms of how do you manage your freight buying, how do you manage the engagement with customers, how do you ensure that you're able to get the material reached to the customers on time. So the combination of all this, which enabled us to have a good, a reasonably good EBITDA per metric ton.
Noted. So I think, sir, you mentioned your specialty contribution going up, but in terms of, specialty contribution, let's say basis our calculation in terms of volume, it's almost like gone down by 4 percentage point. And in terms of revenue contribution, it's gone down by 3 percentage point sequentially. So I'm not sure what I'm missing.
So actually, this is specialty care year on year has grown by about 13%. Okay, and your performance grew by 5%. So there was, so sequentially, I'm talking to you in terms of your year on year. Okay, I'm not talking quarter on quarter. Quarter on quarter, there can always be the changes, but then we are not talking about year on year. Year on year, specialty care grew by about 13%, correct? And performance surfactants grew by about 5.5%, delivering a weighted average of about 8%.
Okay, fair enough. And lastly, I think you mentioned that freight is also included in your pricing, basically the CIF basis. So let's say, does that mean, once the freight situation gets better from October, as you mentioned, our realization and per kg profitability could also come down? I mean, we have seen that happening from 3Q23 to...
No. See, what happens is that the point here is we do FOB shipments, depending on what the customer wants. We do export shipments, we do CIF shipments, we do DDP shipments. Now, what I said was, I was asked, why has your freight gone up to why has your other expense gone up by some 18 crores, to which I explained that it is nothing to do with whether it is an impact because of we are not able to pass on the freight impact. If my DDP shipments were higher in terms of percentage in this quarter as compared to the corresponding quarter last year, the DDP costs are much higher than if it was an FOB. In FOB, there is no freight included. But then once I booked that, I also took a corresponding expense also, correct? So I said that is what I explained. So it is not a question of a margin impact. So it is not a margin impact. Margin impact will be only if we are unable to pass on all the costs, whether it be freight or DDP costs to our customers, which we have been able to do with a lag in the way that the freight rates have been going up. That's what I said.
Noted, sir. Noted, sir. Thank you for patiently answering my question. Wish you all the best, sir.
Thank you.
The next question is from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead.
Thank you. Hi, sir. Sir, first question is just to get clarity that we heard news about Unilever reducing the content of palm oil in their products. Now, has that anything to do with any implication on our products, or is it something else? Just, very basic question, but to get understanding on it.
Yeah. So we actually, first thing is we don't, our products don't have anything in traditional soaps which are made from oil. So there is nothing, no connection with what business line that we are in, because we don't cater into soaps. What we do is synthetic soap, which is a specialty for us, which is synthetic detergent soap. It has nothing to do with what Unilever has announced in terms of reducing the palm content by 25%. So there is no connection with our business.
Okay, understood. Second on, I think in past we have mentioned that Emmet plants also caters to the Europe demand, and so Emmet performance is impacted by what happens in Europe demand as well. Where are we in terms of say demand recovery in Europe, and in that backdrop, how should we see the performance of Emmet subunit, which is impacted by both demand in Emmet region as well as Europe region?
Yeah, so demand in Emmet region, I think even demand in Europe has been looking up, and then we do hope that this continues. But one of the challenges that our Egypt plant had was in terms of availability of feedstocks to continue to have uninterrupted production to serve our customers. So last quarter was a very, very severe quarter in terms of impact of incoming raw materials. But despite that, the team has delivered a 6% volume growth, which is commendable. But with things being where they are today and not further aggravating, I think our team is well positioned to be able to meet some enhanced demand that we are seeing both in Emmet region and in Europe.
So there is no challenge in terms of end user demand in either of the regions. Incremental deterioration when I say challenge.
Yeah, you said very good.
There is no challenge at the end user geographies, that is Emmet or...
The demand multiply seems to be looking up, which is good, but we only need the supply side to be supportive. So I think things, if it doesn't worsen from here on, we should have found a way to be able to participate in the demand growth.
Okay, just and last question. All this challenge in terms of freight rates or container availability is because of the longer route taken by the ships because of this Red Sea challenge, or is there anything else? I mean, any concrete reasons for this, and are you seeing any improvement on that side?
No. See, this is essentially the Red Sea crisis started in November when they skipped going through the Red Sea. So they skipped Suez Canal. They had to go through the Cape of Good Hope. So you had ships taking more time to reach the destination. So containers also took more time to come back. Okay, and then you also have China trying to send a lot of material into the US. Okay, in terms of its EV components to beat the higher duty rates that will kick in from October. So there is a combination of factors that aggravated, which led to congestion at port, unavailability of containers, freight rates going up. So everything, all that could go disadvantageously has happened. So now we are only saying this having happened, it shouldn't worsen from here on. So we don't want any geopolitical escalation that can further mess up with the Red Sea situation.
Noted. Sir, thanks a lot and all the best.
Thank you.
The next question is from the line of Shalini Gupta from East India Securities. Please go ahead.
Yeah, good afternoon, sir. I have 2-3 questions. One is that what is your view on Laurel alcohol prices? They've looked up a bit, but
see, Laurel alcohol prices, have been it is on an increasing trend. So it increased by about 10% compared to the previous quarter in this quarter. But if you see the last 1 month, it has gone up significantly, aided by the increase in the oil prices. So it's like it's gone up by another about 30% in just about 30 days. But then we are also seeing some corrections. So this is a constant seesaw that keeps happening. That's why it's very critical that we need to have a very robust raw material risk management framework in place, which we have. So we're ensuring that we have the right buying done, the timing of the buying and the quantum of buying to take care of this price volatility.
okay. So and you're expecting the high prices to sustain this kind of 30% price increase in 1 month, you're saying?
No, I don't want it to sustain, but that's what it is today. Any increase in feedstock price is going to also result in my customers having to pass that on to consumers, and the demand that is now making a comeback based on the price reductions they have done should not get impacted because they have to then again increase the prices. So it is not good from a consumer demand perspective for the prices to sustain. I only said to the question that you asked that it has started looking up again. And we do hope that it comes back to and gets normalizes at levels it was the previous quarter.
And sir, earlier you had guided for about 8% volume growth for financial year 25. That remains?
Yeah, 6 to 8%. Yeah, that remains.
And what kind of increase in realization are you looking at? 6 to 8% volume growth is clear, but increase in prices?
So prices, we're talking about a EBITDA range we have given. We increased the guidance last quarter.
Yeah.
To 20,500 to 21,500 per metric ton. So that essentially builds in that as well. Volume growth plus increase in EBITDA, which essentially means that we need to have more amount of high premium specialty that should contribute, which we said should happen from H2. That was the rationale on which we increased it, and we continue with the same guidance.
Okay, so that's it from my side. Thank you.
Thank you. Have a good day.
The next question is from the line of Aditya Ketan from SMIFS Institutional Limited. Please go ahead.
Yeah, thank you, sir, for the follow-up. Sir, this rise into the Laurel alcohol prices, is this also related to the higher freight cost globally, which is going up?
So that is one, but then even oil prices have gone up significantly in the last 3 to 4 weeks. Okay. So your palm prices have gone up, palm oil prices have gone up, soybean prices have gone up. So the entire oil complex has gone up, and which essentially leads to an increase in your feedstock, in your derivative prices. Plus the increased freight rate also contributes to that. That is an added one.
Okay. Okay. So, sir, does this rise into the L'Oreal alcohol prices so trigger a revision in your fixed contract prices also, like with the customers you had made?
Yeah, it all depends on what sort of contracts we have. There are contracts where we have quarterly resets for prices. There are contracts where we do a contract for 6 months or 1 year, and then we need to ensure that we have the covers taken at those prices and we close the positions. So there are various. It's not that all customers buy in a particular the same way. So there are different models. Only thing is we need to ensure that whichever model we have, we need to have a system by which we are able to manage the risk in terms of the open positions of the feedstock, which we have a very good system, which is proven over the last 8 years, where we have managed this sort of volatility in a very elegant and effective manner without having any significant impact on our profitability.
Okay. Sir, my second question, sir, I would like to give you sir, two scenarios. Sir, first is in FY24, when the global inflation was high, demand was lower, and exports market were weak. Sir, still we had managed to give an 8% volume growth. Now, sir, this year we are talking of the rest of the world markets showing good volume growth. AMET market also posting around double-digit growth. Indian markets would still be, would show the similar growth of last year. Demand is good. So still, sir, like why are we guiding the similar range band of volume of 6 to 8%? When in negative time it has clocked around 8%. In good times it should be higher, at least considering 10 to 12%. Just want to know your logic for coming to that 6 to 8% volume band.
No, your logic is right, and my logic is also that. But unfortunately, the environment doesn't follow a particular logic, so we have to also be cautious, because I don't want to be guiding higher and then you have external situation is not supportive. So we need to wait for 2 more quarters before we can make a final comment on increasing the guidance.
Okay. Okay. Thank you, sir. Thank you.
Okay.
Thank you. Ladies and gentlemen, that was the last question for today's conference call. I would now like to hand the conference over to the management for their closing comments.
Thank you, ladies and gentlemen. It was a pleasure interacting with you, and look forward to catching up again in 3 more months. Wishing you all a great day and a very nice weekend. Thank you.
Thank you.
On behalf of Galaxy Surfactants Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.